Hi, I'm Philip Borkin from JBWere's Investment Strategy Group. Whichever way you cut it, 2019 has been a remarkable year in markets. For one, returns have been exceptional across most asset classes. Equity markets have had some of their strongest returns since the financial crisis. Bond portfolios have performed well as interest rates have fallen to, in some cases, historic lows. Even things like gold have had a strong year, or it's one of its strongest years since the financial crisis as well. What makes this most notable is that these returns have come despite 2019 being a year where economic news has generally been pretty poor. Global growth has slowed more than expected, and of course we've been having to deal with the extreme uncertainty of the US-China trade war and the debacle that is Brexit. So how do we square that circle? How can returns have been so strong despite economic news being challenging? And quite simply, it comes down to the actions of central banks. They've responded to this poor news and the downside risks by easing policy again. And more central banks have eased policy this year than in any year since the financial crisis. Even in the US, with the unemployment rates at a 50-year low, inflation's pretty much around 2%, the Federal Reserve has cut policy by around 75 basis points this year. And that action by central banks has been welcomed by markets and risk assets in particular, and has contributed to the returns we've seen. What about 2020? What could that bring? Well, when we look forward to the next 12 months, we actually think some of the economic headwinds that have been evident this year are going to disperse somewhat. Certainly some of the actions of the central banks, together with fiscal stimulus that we're hearing in many parts of the world, should actually see growth or global growth start to accelerate modestly next year. And we also importantly think that some of the extreme policy uncertainty evident this year will start to dissipate too. We certainly think Brexit will start to resolve itself early next year, and we're also expecting a de-escalation in the trade conflict as well. So slightly stronger global growth next year, but not strong enough to generate inflation. And that's important because that means that central banks will remain pretty comfortable maintaining the level of stimulus that they've delivered this year. So better growth, low inflation, central banks that are remaining pretty friendly should be a pretty favourable environment for equity markets. And we're expecting positive returns next year. Trouble, of course, after a year that we've seen, equity markets have almost baked in a little bit of the good news already. And not only that, the big tailwind of lower interest rates this year, which has driven equity markets higher, is unlikely to be repeated. So equity markets will need to find another source of propulsion to drive them higher. And we think that will come in the form of earnings growth, which slightly better global growth will assist with. But it does mean that, while positive, equity market returns are likely to be just a little bit more modest than we've seen this year. Where could we be wrong? What are the risks? Well, I suppose it goes without saying is that the trade war between the US and China is still unresolved. So we really do need to see a de-escalation there. And maybe we never see a complete resolution, but de-escalation is certainly important. We could be wrong on global growth. Maybe it won't accelerate, or even modestly like we suspect, that stimulus from central banks won't prove as positive. But I would say there that we're already starting to see some tentative signs in the data flow that things are picking up again. And then over the second half of next year, look, the US election is shaping as a pretty critical event. It looks like it will be incredibly close, but some of the policies proposed by some of the Democrat candidates have the potential to be pretty disruptive for markets. So we're watching those risks closely, and it does create the risk of some volatility. But like I said, we think equity markets are still reasonably placed to record some positive returns next year, albeit more modest than what we've seen this year. Look, I'll leave it there, but I'd just like to take this opportunity on the behalf of the JBWere Investment Strategy Group to wish everyone a Merry Christmas and a prosperous New Year. Thank you.